The real affordability crisis isn't inflation, it's the cost of bad decisions. Every night, we're told why America has an affordability crisis: inflation, interest rates, housing shortages, supply chain disruptions, labor costs, natural disasters, rising insurance premiums. Every one of those explanations contains some truth. But I believe we're overlooking one of the most expensive forces driving affordability in America. It's rarely discussed, it's almost never measured, and yet it quietly affects every homeowner, every business, every insurance company, and ultimately every family trying to hold onto the American dream. I believe the real affordability crisis isn't inflation, it's the cost of bad decisions. That may sound like an oversimplification. It isn't, because every time a bad decision is made, someone pays for it. Sometimes it's a homeowner, sometimes it's an insurance company, sometimes it's a contractor. Eventually, the cost always finds its way into someone's wallet. And over time, millions of those decisions become billions of dollars. Before I explain why, let me tell you something about insurance that most people never see. When a storm damages a home, the storm isn't what determines the final cost. The decision does. Two homes can sit side by side, built by the same builder, covered by similar policies, damaged by the same storm. One claim is handled correctly. The damage is identified. The repairs are properly scoped. The homeowner gets back to normal. The claim closes. The other claim starts with one bad decision. A roof is underestimated. Water damage is overlooked. A repair is approved that should have been a replacement. An inexperienced adjuster misses something. An engineer is asked the wrong question. The file is reassigned. Another inspection is scheduled. Weeks become months. Months become a year. The homeowner hires experts. The insurance company hires experts. Attorneys become involved. Engineers write reports. Appraisers are retained. Mediations are scheduled. Interest begins accumulating. Administrative costs continue growing. The repair becomes more expensive because time has passed. The relationship between the homeowner and the insurance company deteriorates. Eventually, everyone spends more money than they would have if the original decision had simply been correct. Now ask yourself a simple question. What actually made that claim expensive? Was it the storm, or was it the decision? I spent decades in construction before I ever adjusted an insurance claim. I built homes, renovated historic buildings, solved structural problems. Then I became an insurance adjuster. Later, I became a public adjuster representing homeowners. I've seen claims from nearly every perspective possible. And over the years, I began noticing something. The most expensive claims weren't always the biggest disasters. The most expensive claims were often the ones where the wrong decision was made early. Because bad decisions compound. A missed problem becomes a larger repair. A delayed inspection becomes additional damage. An incomplete estimate becomes litigation. An incorrect coverage decision becomes years of unnecessary expense. Every poor decision creates another decision. And every new decision costs money. We spend enormous amounts of time talking about claim costs. Very few people talk about decision costs. Maybe we should, because decision costs don't appear on a line item. They're hidden. They're buried inside delay, reinspection, administrative overhead, expert fees, legal expenses, customer dissatisfaction, lost productivity, lost trust, and eventually higher premiums. Think about that. Every unnecessary dollar spent correcting preventable mistakes doesn't simply disappear. Insurance companies must account for those costs. Reinsurers account for those costs. Investors account for those costs. Regulators account for those costs. And ultimately, policyholders account for those costs. That's how affordability quietly erodes. Not all at once, one decision at a time. Now let me be very clear. This isn't about blaming insurance companies. It's not about blaming contractors. It's not about blaming public adjusters, attorneys, engineers, regulators, or homeowners. It's about recognizing something much bigger. Every participant in the system is affected by decision quality. When decisions improve, everyone benefits. When decisions decline, everyone pays. That's why I don't believe technology alone is the answer. Technology is remarkable. Artificial intelligence can review thousands of photographs. Satellite imagery can monitor entire neighborhoods. Estimating software can calculate repair costs in seconds. Data has never been more powerful, but none of those tools make decisions. People do. Technology provides information. Judgment gives that information meaning. And somewhere along the way, I think many industries began confusing those two things. Information is not judgment. Software is not experience. Speed is not wisdom. We've become incredibly good at processing information. I'm not convinced we've become better at making decisions. In fact, I think the opposite may be happening. As technology becomes more sophisticated, organizations sometimes begin trusting systems more than people. The software says this. The model predicts that. The algorithm recommends this outcome. Those tools are valuable. I use artificial intelligence almost every day. It helps me research, organize, challenge my own assumptions, become more productive. But I don't ask artificial intelligence to replace judgment. Those are two completely different philosophies. One replaces thinking, the other improves thinking. Insurance simply happens to be where I see this every day. But this isn't really an insurance story. Medicine faces the same challenge. Engineering does too. Education, finance, government. Every profession is asking the same question. How much human judgment should technology replace? I think that's the wrong question. The better question is, how can technology help people make better decisions? Because the future won't belong to organizations with the most software. It will belong to organizations that combine remarkable technology with remarkable judgment. And that brings us back to affordability. If we continue measuring only the cost of disasters, we'll never solve the affordability crisis. We also have to measure the cost of poor decisions, the cost of unnecessary delays, the cost of avoidable disputes, the cost of inefficient processes, the cost of replacing experience with systems that were never designed to think. Those costs are real. They're simply hidden until they arrive in your mailbox as another premium increase, or another deductible, or another family wondering whether they can still afford to own the home they've worked their entire lives to build. Inflation certainly affects affordability. There's no question about that. But inflation raises prices. Bad decisions multiply costs. And when millions of bad decisions ripple through one of the most important financial systems in America, affordability isn't simply challenged. It's engineered away, one decision at a time. Perhaps that's the conversation we should be having. Not simply how to make insurance cheaper, but how to make decisions better. Because when judgment improves, costs fall, trust grows, disputes decline, and affordability has a chance to return. The real affordability crisis isn't inflation. And unlike inflation, that's something we can actually choose to improve. Please like this video, subscribe to the NAPAICC Insider Podcast on YouTube, and share this with someone who needs to understand what is really driving the affordability crisis. Because once people understand why, they stop accepting nonsense as normal.